Well, hello everybody, and welcome to Real Wealth Network's weekly webinar. How you doing? So glad you could join us. This is Ben Smith. I'm the Investor Relations Director and also double as an IC, depending on the mood that I'm in. So today is September 13th, 2018, and we've got a good one today. At long last, we're gonna speak with Caeli Ridge of Ridge Lending Group. She's gonna talk about, I won't steal any thunder, Caeli, but she's gonna talk a lot about conventional loans, non-conventional, what to do when you hit 10, how do you go off the reservation from a lending standpoint? What's the right way to do it? So it's been a long time coming. We're looking forward to this. Coming up on Saturday the 22nd, Caeli's going to be with us in San Mateo. We're also going to hear from, as we normally do with most events, we've got 3 different affiliates. Actually, 2 of them are actually the same, but we're going to hear from 3 different cities. Chicago's going to talk about their market. Kansas City's going to talk about their market, and St. Louis also. Just so happens that the same outfit, the same affiliate does both Kansas City and St. Louis, so that'll kind of make it a little more efficient. They only have to talk about property management once, but we'll go over all 3 of those cities, and Caeli's also going to be talking about what you're going to hear in about 5 minutes. And then the following day, on Sunday the 23rd, we'll be down in LA, 2 to 5 p.m., and on the 24th in San Diego, 6 to 9 p.m., because it's a Monday, we do it later so people can go after that. Now, Caeli is only going to be presenting at our San Mateo event, so sorry to the Southland. She's not going to make it down there, but that's why we have this webinar, and that's why this webinar will be archived. Usually it takes about 24 hours for us to archive it, but it will be available on the Real Wealth Network website, and so you can watch it again and again on the website if you like, and ideally we'd love to see you at the event. If you haven't booked for it, please register for it. realwealthnetwork.com/live-events/ we really want people to register so that we don't have the last minute scramble trying to get more seats in and making the hotel nervous because we're violating fire code and all of that. So if you could register, and everybody needs to register. You can't just bring Uncle Fred with you at the last minute. Uncle Fred needs to register as well. He will be able to register at the door, but we really prefer that you avoid that if at all possible. So I'm going to turn it over to Caeli. We've been working with Caeli for years and years and years, based up there in Oregon, and I've done a couple loans through Caeli. I know a lot of our members have. We've had really good luck. She's just a great lender, and she also does a lot of the off the beaten path stuff in addition to the conventional. So I'll stop giving previews and just turn it right over to you. Take it away, Caeli.
Thank you, Ben Eric Smith, so much. I am so happy to be here. Thanks so much for having me. Hey, gang out there in virtual webinar land. First of all, what do you think of that prom picture, everybody? I think it's time. I think it's time that I update that thing. I'm looking at that, and it's probably due for a refresher. I'll work on that. Again, I'm so happy to be here with you guys today. I think I've got some really good information for all of you. Thank you for taking what I assume is your lunch hour to be with us. So I'm going to get right into it. And some of these slides and some of this intel, I may kind of run through quickly to give us a little bit more time at the end for Q&A. Much of the content of lending is so subjective to the individual and what their needs are. I think it's usually more helpful that people can get some specific questions out that relates to them, and we can spend a little extra time on that. So today's webinar, we're going to talk a little bit about what's new in the lending world for investors, what has not changed, and then a little bit about what I believe, kind of, I've got my finger on the pulse, I think, what I think that we can expect, at least in some ways, in the future. And by future in lending, you guys, I should probably mention, 3 months is a long time in the lending world. So I'm probably going to be forecasting the next 3 to 6 months in terms of some of the changes that I expect to see, and I'll share those details with you. So without further ado, let's get into this thing. I can feel your guys' energy from here, the Pacific Northwest. You're pumped. I know it. All right. Okay. So before I get into some of these bullet points, let's talk about the difference between the primary product types that we're going to talk about today, conventional financing and then specialty financing, also called non-QM. QM stands for qualified mortgage. Conventional financing is a qualified mortgage, and pretty much everything else is considered non-QM. So most of you conventional, you know that these are the Fannie Freddie loans. Ridge Lending calls these the golden tickets, highest leverage, lowest interest rate on the planet. And then specialty loan terms are the non-QM that kind of encapsulates most of what we fund outside of conventional, that is still a single loan per property, 30-year fixed leverage. And actually, for all intents and purposes, you guys, specialty is almost identical to conventional in every way for investors, with the exception of expanded product type and then interest rates, really. It's still, like I said, a 30-year fix, same leverage. Underwriting guidelines are going to be relatively the same. We'll talk a little bit about that. But in any case, I just wanted to quickly define the difference between conventional and specialty. So let's get into some of the meat of this. So most of you know, conventionally, there are 10 golden tickets per qualified individual. One of the changes that we recently saw is Freddie, up until a couple of months ago, only allowed 6, whereas it was Fannie that took us all the way to the 10. Freddie is now up to 10, matching Fannie, which was kind of nice. Freddie typically prices out better. Interest rates for Freddie Mac sold loans are generally a little bit more aggressive. So for our investors that were in the 7 through 10, we had to price Fannie. Now we've got a little bit, I think, some incentive or maybe some improvement in rate for those investors that are kind of in that secondary 7, 8, 9, 10 loan spot. Debt to income ratio went up this year. 50% is now the baseline. Before we could get to 50%, but it required compensating factors. Those would be things like low debt to income ratio or strong assets in order to qualify for the higher end 50% DTI, debt to income ratio. So that's nice. There is no compensating factors required any longer. We can go straight to the 50. The reserve requirements also changed. Now this has been a change, it's probably been a little over a year ago, and this is very different than the old reserve requirement. I'll just take a second and define reserves. So when you're qualifying for a conventional loan or even a specialty loan, in addition to your down payment, we want to see a certain amount of reserves, liquid or non-liquid funds, to show that you have the ability, if necessary, if let's say, for example, the property went unrented or, whatever circumstances we're talking about, you have some source of asset that you could use to cover your mortgage payment. The reserve requirement used to be, between 1 and 6 months worth of PITI, principal, interest, taxes, and insurance. And it changed on a tier basis depending on how many finance properties you have. Now it's based on the unpaid principal balance of the outstanding rental property loans. I have a matrix. Hey, Ben, I have something that might be helpful to the listeners that I can forward you straight from Fannie Freddie guideline that if you guys wanted to post, I don't know if you can do that, post along with this webinar that might be helpful for them to have access to. So I'll just go over it real quick. Yeah, go.
Okay. I was just going to say, just get that to me, and then we can figure out a way to put it on our website so that folks can go to the website and grab it from there.
Perfect. I would just caution you guys, double check every couple of months to see if there's been a change. Most of you probably know underwriting guidelines can be like a moving target. So this is valid today at 12:11 p.m. on the 13th of September. Who knows when they may, change the playing field a little bit. Right. But very quickly, you will have access to this, I think. So depending on how many finance properties you have, the reserves, again, are based on the UPB, unpaid principal balance. 2% of the aggregate unpaid principal balance is what we need to calculate in loan spots 1 through 4. 4% applies to the loans 5 and 6. And 6% applies to those in 7 through 10. And this is retro, okay? I'll explain in a second. I'm going to give you an example. Now, the primary residence of the individual is not calculated in the reserve requirement. So the easiest example that I can give, or that I usually give, is, in addition to the unpaid principal balance, I apologize, we need to also show 6 months of PITI, that's again principal, interest, taxes, and insurance for those that might be newer, on the subject property. So the example would be, let's say the individual is purchasing their 10th property, and this is their 10th conventional loan, and of that, the first, let's say number 1 property is their primary residence. So they've got properties 2 through 9 our rentals, and then number 10 is our subject property. Let's also assume in this example that each one of the 2 through 9 mortgages that they hold for those rentals has an unpaid principal balance of $100,000, just to keep it nice and round. So that's what, $800,000 of unpaid principal balance, right? Now I'm going to take 6% because I'm now in the 7 through 10 finance properties and multiply that times my $800,000. There's $48,000 of reserves that we would need to show for that portion. Now we also need to add to that the 6 months of PITI for number 10, our subject property. In this example, let's keep numbers round again and say that the PITI is $1,000 a month. Times 6 is 6,000. I take that and add it to the 48,000 that we just calculated, making the reserves in that example $54,000. Okay? Again, liquid or non-liquid funds are applicable to satisfy this condition. So 401k, self-directed IRAs, all of that is applicable. Maybe a little TMI in terms of detail there, but you'll have the matrix, I'm sure, once Ben gets it and can get it on the website for you. Some of the other things that have changed, delayed cash out refinance. So very briefly, for those of you that are not aware of what this is a conventional loan product that allows an individual to pay cash for an investment property and then turn right around and refinance that property at 75% of the ARV, that's after repair value. For quite a while, up until about, a year ago or so, that was capped at 70%. It's now increased to that 75%. So that was a nice change.
Can I ask a question real quick?
Yeah.
What about if it's a 2, 3, or 4 unit? Is it still 75?
Very good question. And the answer to that is no, unfortunately. The 2 to 4 units are typically going to be limited. They usually are cut about 5% in each different tier, based on product type, et cetera, to the single family. Mm-hmm. So it would be 70% in this case.
Got it. Thank you.
Let's move on. Yeah. Now let's move on to that specialty side of the aisle. Again, non-QM, this means outside of what Fannie and Freddie are insuring and purchasing. A couple of unique things that we've found is that there is no longer a limit to how many of these non-QM or specialty loans that I can get per individual. Prior, we were really limited in the specialty investors that we could resell these loans to. Over the last couple of years, the number of secondary investors for these types of mortgages have really expanded. So we have dozens and dozens of which each of them allow anywhere from 8 to 20 of these specialty loans per individual. So we really aren't finding, at least not yet, that there has been any limit to how many of these we can secure per investor. Expanded products, this is kind of cool. I'm kind of excited to share some of this with you. So within specialty, I mentioned briefly that the criteria for qualifying between conventional and specialty are relatively the same, right? Similar underwriting, 30-year fixed, same leverage, et cetera. But now we also have access to more asset-based underwrites. And what this means is that instead of looking at the individual's debt-to-income ratio, for example, we're going to be able to use a product that lets us calculate the debt service ratio of the property. This is going to be a division of the gross rents and the property's PITI. Okay, so it's kind of geared more toward maybe a commercial loan and how they would underwrite it. The focal point is the property. Secondarily, it's the investor itself. So this is exciting. We've got 30-year fixed products for debt service ratio. The rates are going to be higher. I'll kind of give you a comparison later on in a few slides, but this is going to be for individuals that perhaps a self-employed individual that really does everything they can to minimize the amount of taxes that they're paying on an annual basis. I'm raising my hand right now. Or just don't fit inside the confines of the conventional or even just the standard specialty. This is a unique product. So again, we're really looking at the debt service ratio. We're not looking at the borrower's income, the individual's income versus their debt. The property needs to stand on its own. I don't think I mentioned, within that division that I gave you, the gross rents by the PITI, the formula needs to yield a 1.15 or greater to qualify under the specialty DSR loan terms. On this product, you guys, they don't like to see loan amounts under $135,000, so just be aware of that. And you can expect interest rates to be somewhere in the high sevens. 7.75 would be a good barometer if you're trying to run numbers or ROI. The other thing I would mention about specialty is I'm really starting to see the playing field level. The difference between conventional interest rates and our standard specialty interest rates are really starting to narrow. A couple of years ago, I was looking at most of us probably on the call remember the 4.5% 30-year fixed interest rates for investors. That's not the case today. But back in the day, the difference between these and the specialty rates was probably 2-3%. Now it's under a 1% margin. So if we're at maybe 5.75 on a conventional loan today, we have rates based on the characteristics of the loan, of course, that are running at 6.3, 6.6. So that's been very telling to me, and I'll explain that a little bit more when we get into some of the slides about the future. So that's kind of what's new for conventional and specialty. Let's quickly go into what has not changed. So some of the stuff that's just static, I wanted to quickly go back over for some of you. Conventional, still 10 per qualified individual. So single family residence, 80% LTV on a purchase, when in fact the real truth is 85% is viable. That loan will carry PMI, private mortgage insurance, for those of you that aren't aware of that. Interest rates on the 85% are going to be slightly higher as well. But if you've got, so for an individual that has a certain amount of capital that they want to get out there in real estate investing, that extra 5% may be the difference between, starting now versus later. Maybe it allows them to get into maybe 2 properties versus the one that they thought that they could. So 85% with PMI is not necessarily a bad thing. Most people hear PMI and they kind of go, I'm not interested. But I think that most people would be surprised at how low the factor is. Generally speaking, it's largely credit score dictated. But if you have a 740 or greater, your PMI factor is probably somewhere around 0.52%. The formula to calculate that is going to be to take your loan amount times 0.52% and divide that by 12. As a very quick example, let's say that our loan amount is $80,000, okay, times 0.52% divided by 12. The PMI factor is $34, you guys. So for an extra 5% of leverage, it may or may not be worth it. I would suggest looking at both scenarios side by side before you make any definitive decision on that.
And then isn't it also true that if you do pay PMI, it's not like you're committed for that extra $34 for the length of the loan. You can request that the PMI be removed after you reach a certain amount of equity, right?
I love you, Ben. Thank you. Yes, exactly. Good point. I'm glad you brought that up. So, and I don't remember which is which, but between Fannie and Freddie, each of them has a minimum number of months you have to keep the PMI before you can request the removal. One is 12 months, the other one is 24 months. Again, I don't remember which is which, but let's just say minimum is 24 months. But you are absolutely right. So with a combination of appreciation and or principal balance reduction, you can request that the PMI be removed at the cost of a new appraisal is really all the expense it will take to get rid of that. You need to be at 78% LTV, however. It's a little weird. It's not the 80% you would think it would be. But as long as you get down to 78%, that PMI goes away. Exactly. And another thing I failed to mention, PMI on an investment property is a tax deduction versus it is not on a primary residence. So there, maybe some additional incentive.
Yeah. Okay. Good to know.
Yeah. Single family residence cash out, 75%. That's delayed or standard cash out refi. The 2 to 4 unit, 75% on a purchase, 70% on a cash out. Credit score requirements have remained unchanged. I'll go over that briefly. So of the 10 golden tickets, you guys, there are 2 very distinct underwriting books, we'll call them, that we must adhere to get you a Fannie Freddie loan. The first set of rules or underwriting book applies to loan spots 1 through 6. Then there's a second and new set of underwriting guidelines that we have to subscribe to in 7, 8, 9, and 10. Credit score for 1 through 6 is not hard and fast. There's really, it's kind of vague. Lower credit scores of 650 can get a loan, for example, if they have those compensating factors that I mentioned before. In this case, that would be low DTI or strong assets if they have a slightly lower credit score. So in 1 through 6, no solid hard and fast rule. 7 through 10, they raise the qualification bar, and you must maintain a minimum middle credit score of 720 or greater to qualify for any one of those remaining 4 golden ticket loan spots. Okay?
Got it.
Okay. I think I kind of covered a lot of this, but just very briefly, the specialty loan products, we still have the 30-year fixed. The leverage hasn't really changed. Similar to Fannie Freddie, there may be some opportunities on specialty to advance in leverage a little bit, where a cash out, for example, is capped at 75% conventionally. In some cases, we can go to 80% cash out on a specialty loan. I'd want to talk case by case scenario with whoever's interested in that, and we can discuss further. Also, prepayment penalties they're very common on the specialty loan terms. If we're talking about a buy and hold strategy, however, I find that the prepay is really fairly irrelevant. Depending on the product, it's between 3 and 5 years. The 5-year prepay is reserved exclusively for that debt service ratio product I mentioned. Otherwise, it's always a 3-year prepayment penalty. And the penalty for anyone that's interested would be calculated as follows. We're going to take 80% of the outstanding principal balance. So let's say $100,000 is your balance due. We'll take 80% of that, so $80,000, and multiply that times 6 months worth of the interest that you pay. And that's the penalty in the first 36 months. Once 36 months is up, no more penalty applies.
Mm-hmm.
Okay, so let's go. The future. Here's what I expect to see. So there's been a lot of talk, and this is actually not anything new in terms of the rhetoric out there, but over the years I have heard that Fannie and Freddie are considering opening up to kind of the static 10 that we've been dealing with for some time now, to maybe 12 or even 15 of those golden tickets. So be on the lookout for that. Sometimes I'll make a joke and say that, we expect to hear the official announcement of this sometime between now and my death, because it has been around for a while. But the news wire seems to be heating up on that topic. So maybe first quarter next year. Certainly ping me if you'd like to at any time and say, hey, any update on this? Because it certainly would open up quite a few more golden tickets for those individuals that, may be getting close to their 10. I'm not going to go into too much detail about this next one because it's a little bit convoluted, but we are expecting to see some expanded guidelines for self-employed borrowers and how their income will be calculated. It'll be an improvement, at least from our perspective. They're going to loosen the purse strings a little bit. I don't think anybody is surprised to see the next bullet there, higher interest rates. Yes, I expect that to continue. I'm going to talk a little bit toward the end of the slides here about interest rates as it relates to us and our investment property needs. But yeah, you can expect to see rates go up. The Feds are meeting again here, I think, in the next couple of weeks. The prediction is largely that they will raise the Fed fund rate again by probably 1/4 point. But I want to stress, you guys, that a couple of things. When the Feds move the Fed fund rate, it is not an immediate and or an automatic that the long-term mortgage rates are going to be affected. As a quick example, December of last year, they raised, first time in a while, and we didn't see any real impact, negative impact to our long-term rates. It wasn't until March, I think it was the first Wednesday in March, really, that we saw that big rate hike, the first one we'd seen in about 4 years, and that was a function of that stock market dive that if any of you remember the headline, that was really what precipitated the jump in rates, and then later that month they raised the Fed fund rate again, and we saw a new increase. So don't tie or equate the two as the same thing.
Mm-hmm.
Specialty, I kind of touched on these already. In addition to some of the products I mentioned for specialty, I expect that to even grow further. Expanded bank statement products for investors. I'm not sure we're going to see any significant leverage increase. I think that they're going to continue to maintain some skin in the game, but I think they're going to loosen on the qualification a little bit. We'll see on that as the coming months pass. And then the pricing, I talked about that a little bit. I mean, we're already within a 1 point or less between Fannie and the specialty investors. I expect that to continue to narrow and become more competitive with one another. So that's kind of exciting, just having, more players evening out the playing field, I always think is a good thing. Okay, so these are kind of self-explanatory, but people often ask me this question: what are a few of the common reasons that people may not qualify or a loan blows up in the middle or the end of the transaction? Added or undisclosed debt. That's pretty obvious, right? The debt-to-income ratio is clearly very tied to the monthly debt found on the credit report. So if there are added debts that weren't disclosed to us and it takes us over that 50% threshold, and there are last-minute checks in underwriting, it's called QC, quality control, that'll blow us up. Unseasoned or unverified funds. I have had clients over the years where upon pre-qual, which is a very rigorous process for Ridge, they had the appropriate funds, but 30 days later they lent it to their brother and they borrowed some other funds from their parents, and that just doesn't fly. It's not a seasoned asset at that point. So very important to just keep the communication open. If there are circumstances where debts and or assets need to be shuffled around, just talk to us and we'll make sure to advise you appropriately. Clearly, loss of job or income would be a big one. But the other one, undisclosed properties. This happens more often than you might think, where let's say Mr. Smith is working with us to close Front Street property, but at the same time simultaneously, and this is his 10th property with us, okay? He's also working with Front Street Mortgage to close on another property, unbeknownst to us. It didn't occur to him that we would need to have that information. Well, clearly and they'll find out. So there's all kinds of platforms. LexisNexis is the biggest one, where those reports will be run last minute, and any transaction under escrow, it's attached to the individual social security number, that will come up and it'll be questioned, and I'm dribbling on about it. Long story short, if you have multiple transactions going at once, it's very important to disclose that to your lender, your mortgage provider.
And it's also just very important to try to keep things as simple as possible, because the more ripples there are, the more documentation you're going to have to produce, and every answer sometimes causes 3 more questions to be asked. And just don't apply for that loan for that Lamborghini until after 123 Main Street loan is closed. Just hold off.
Good.
Just keep your lead foot in check for 1 more month, for example, right?
Good point. I'd go for the Ferrari, but yes, good point.
Yes, fair enough. Just in case anyone's unclear, the definition of debt to income is if you make $10,000 a month, then let's hope that your debts don't exceed $5,000 a month, which would be a 50% ratio. I mean, that's as simple as it can be in terms of an explanation, right?
Yeah, very good. Well, since we're talking about that, because it's a little bit more complicated than the assets and the credit, let me just add a quick comment. So, yeah, the DTI is pretty simple. It's a division of your income that we've extracted from the documentation you've supplied us to the monthly liabilities found almost exclusively on your credit report. The almost is equal to 3 things. These 3 things must be in the DTI but will not be found on the credit report. If you're a renter, 1, HOA dues, 2, taxes and insurance paid separate from the mortgage payment would be 3. Otherwise, everything else is coming from the credit report. So things like utilities, cell phone, gas, entertainment, food, all of that stuff is not part of the equation when we're calculating DTI in underwriting. Now, that's the baseline. Obviously, we need to start accounting for the new mortgages for the properties, but you also have rents to offset that. I'm not going to take us down that rabbit hole, but anyway, that's just kind of an extra to what's included and what isn't.
Perfect.
Okay, so I love this slide, and I always like to throw it in when I can. I just think it's kind of cool. Most people were not aware of this, but it's true. Look it up. We are one of 3 countries in the world that have a 30-year fixed mortgage. some of you just in hearing that statement know where I'm going with that. What does a 30-year amortization do for us as investors, right? I mean, that's where the cash flow comes in. I mean, it's all about that cash flow right now.
Right.
Everywhere else in the world, you're looking at, if you're lucky, a 5 or 10 year.
And of course, a 5 or 10 year just destroys the cash flow.
Check it out, you guys. So here's the example. I just like to make a point of how powerful the amortizations of the loan types that we can get in this country are for us as investors in the cash flow. So you can see right there, we're using a $100,000 loan. There's our 30-year fixed. You see I use 5.75. My comparison is the same on a 5-year fixed, so that's a 60-month amortization, right? I use 4.75. I wonder, it might even be higher. I don't know. I was just trying to give it the benefit of the doubt. But check that out.
Wow.
That's $1,300 so, I mean, what does that mean? That pretty much everywhere else in the world, you're not going to have rental properties or properties, real estate as an investment tool to create wealth. You couldn't, right? Well, I guess that's not true. If the rents were on a $100,000 property, if the rents were $2,600 maybe, but anyway.
Right.
Okay.
The difference is very stark, and you even just, you have a one point differential in the other country's favor for interest rates, just to kind of make it as illustrative as possible, and it still just blows it away to have a 30-year AM as opposed to a 10-year AM. Makes the difference between it's a good investment or it's a money pit.
Yeah. And I just think it's kind of fun to illustrate the point. Yeah. Okay. So where are current interest rates on investor loans? Why are interest rates? I think I touched on this early on, you guys. I want to take a minute and put interest rates and the fact that we can pretty much guarantee in this country they're going to be on the rise. Why is that less important to us as investors? So I'll start with current interest rates. Now, when we talk about interest rates, either conventional, specialty, whatever, there's a whole variety of variables that will dictate or play a role in what the actual rate you receive will be. These variables are things like occupancy is a big one. Very different scenario on rates between an owner-occupied and a non-owner occupied. Loan size is another big one. The smaller loan sizes tend to get hit a little bit harder in interest rate, but I'm going to come back to why that's really not such a big deal. Credit score, LTV, property type, purchase versus refi, cash out versus rate and term, all of these different criteria or variables play a role. So what I can tell you today in terms of interest rates on conventional loans is I'll give you a range. You should expect to see interest rates between 5.375 and 6%. And I know that's quite a stretch or a margin there between the two, but again, let's talk optimally. I can give you a better example. So if we've got over $100,000 loan size, single family residence, 80% loan to value purchase with a borrower that has a 760 or better credit score, the interest rate today is probably going to be in the 5.5 to 5.6 range. To be conservative, I would say. I tend to be, over 20 years in this business, human nature has taught me people tend to remember the first thing that I tell them, which is fine. I do the same thing. But for that reason, while I'm quoting on at a Thursday afternoon podcast, I'll probably be a little bit conservative in my assumption. So take that with a grain of salt, okay? Interest rates for investors. The primary reason I bring this up is that as interest rates increase, and again, for posterity, we expect that to happen, what happens to rents? Obviously, they'll go up. Now, unfortunately, they're not tied hand in hand. It's not simultaneous. We're usually going to find that it's going to take, 3 to even 6 months before interest rates start to catch up with rental rates catch up with the interest rates that are on the rise, but they will get there. Additionally, you guys remember that if you're not appreciating your rents by a modest 2% a year, you should be, I believe. Now, I don't know if I'm speaking outside of what your thoughts on that, Ben, are, but that's my own personal idea of optimal
If you
return.
you absolutely should, because inflation is typically 2 to 4%, and if you're not raising your rents, then essentially you're losing, you're treading backwards.
Right. So, I mean, it clearly just those two examples alone kind of illustrate my point that interest rates for investment properties are less of a concern than the one that you're going to put on your primary residence in a home that you plan to be on for many years or through retirement, right? It's a very different conversation. When I got into this industry, and for those that I didn't say this early on, but just very briefly, my background, that for those that don't know, I'm a fellow real estate investor. I've held 42 properties at any one time across the United States. So I have a unique perspective focusing on investor needs for their lending and being an investor. Early on, when I was heavy in my acquisition, I got really tied up on interest rates. I mean, really tied up. I was kind of a psycho about it. I was checking the ticker tape, all throughout the day. I was hedging my bets. I was floating. I was, and I quickly learned that it was more of a psychological thing for me than it really was about the return on the investment. And I find that a lot of my clients start off that way too. The analogy that I give, and if for some of you that I've worked with, that we've talked before, you've heard this, it started to become where I was tripping over dollars to pick up nickels, if that makes sense. Because when you look at the investment itself and the two examples that I just gave you, in addition to which the loan sizes that most of us, the national average that investors are closing on, let's call that a loan size between 100 and 120,000. The difference in an eighth or a quarter, even a half a point in rate is literally dollars, right? The big picture, it's not going to really, and don't get me wrong. Okay, let me stop here for a second. I am not at all expressing that I don't think we should go for and try to secure the lowest possible interest rate. I'm simply saying that the interest rate for investment properties is not as substantial a piece of the puzzle as many make it out to be. It's very, very important, but it's not make or break. And yeah, I'll leave it there. I'm sure people will have questions about, oh, look at that. That was my last slide, wasn't it?
That was perfect. Well, and I will also add to that. I also don't think it's as important because, I mean, this is a generalization, but generally the house you buy for your principal residence is going to be more expensive than the houses you're buying for investment. So, the difference between 5.25 and 5.5 on a $80,000 loan or $120,000 loan, yeah, it's a few dollars, 10, 15, 20 a month, but it's a much bigger deal when you're buying a $500,000 place to live in. I mean, that's just assuming that your primary residence is probably going to be more expensive than your investments. So for that reason, it's also less important.
Agreed.
And so we do have some questions here. So let's see.
Okay.
I'll just start from the very beginning here. Here's a question from Rory. What documentation is required for a specialty, quote unquote, specialty loan for a self-employed investor with more than 10 rental properties? And maybe you can't get into all the details, but is there extensive documentation for someone like that?
Yeah, Rory, if you're trying to go full doc and get the better interest rate on the specialty, then yeah, it's going to be very similar to what you came to expect in the conventional. The joke I make about this is that, you're going to need to have your vials of blood and DNA samples set aside for, the qualification piece. If that's a problem for the qualification, or you'd rather look at the debt service ratio product, you can do that, where we don't need those tax returns. We don't need all of those blood types and fingernail clippings and such. Does that answer the question?
Yeah, I think so. I mean, it's fairly extensive, but it's not that much more extensive than a golden ticket loan would be, is what you're saying.
It might be a little bit less, not much. I wouldn't expect too much of a ease in that arena on the specialty if you want full doc better rates.
I mean, just a personal story. One time, this was a couple of years ago, but I had to get a portfolio loan. It was a condo type. It was just a different type of investment, and it wasn't, for whatever reason, I don't remember why, it was not eligible for conventional. And it was a real pain, to be honest. I mean, it was just like I had to do all these little letters of explanation, LOEs, for like every little thing. Like why does your 2016 tax return have an undocumented $150 rebate from, just some obscure thing? And I'm like, I mean, and so I had to write a piece of paper that said, LOE, letter of explanation. The reason my 2016 tax return had $150, blah, 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 blah. I mean, and there literally, Caeli, were like 20 of these, and they kept dribbling in like 2 a week over the 10 weeks. But
how long ago was this?
It was maybe 18 months. I
Hmm.
don't know. So I don't know. Maybe that lender was particular. It was not you. I'll point that out.
Thank you for saying that, Ben.
Yeah. It was not you, but it was a portfolio loan. But it was easy for me to answer those questions, but I was annoyed that I had to answer them to begin with repeatedly. But anyway, okay. A couple more questions. Let's see. For debt to income ratio, are you going by gross income or after tax income?
It depends on how the individual is paid. This gets a little bit dicey. Okay. If you want to talk to me offline, it might be I can answer you more specifically. Sometimes we can gross up income, right, on VA benefits or Social Security, things like that. Just a straight W-2, we're going to go off gross.
Got it. Okay. And I'll let you answer this, but what states are you in? Or you do a lot of states outside of California. In fact, you hardly ever do California stuff, right? So what states?
We do California all the time. Usually, though, it's more owner-occupied. Yeah.
Yeah. Okay. So
we are really, I say nationwide. There's I think there's 7 exceptions.
Okay.
Let me see if I can get them all off the top of my head. New York, Alaska, Rhode Island, Wisconsin, West Virginia. Mm-hmm. Maybe West Virginia. Oh, I'm missing one.
Can you do Texas?
I think there's one more. I can do Texas, yes.
Okay. I know that they're sometimes hard to get qualified in, but so that's great. The bottom line is you do every market that Real Wealth Network currently is talking about and has affiliates in, so that's good.
Yes.
Okay. Let's see. Oh, Hawaii, is that one of them?
Yep.
Oh, you can do that. Okay. All right. Let's see. This is more of a general question. The question is, for investment purposes, in your opinion, is it better to go for a lower interest rate by paying 25% down, or pay only 20% down and save that money for a down payment on another property?
Excellent question. I'm glad whoever is asking this question. Hands down, there's no comparison. The math will not lie. Take the leverage. When you guys do the math, and I'll give you a quick example, the 20% down is absolutely to your benefit. That kind of goes back to that psychological thing, man, with the interest rates. Let me tell you. So let's just take a $100,000 loan. Okay, we're talking about, or $100,000 property. We're talking about the difference in $5,000 in out of pocket. So we've got a loan amount of $75,000 and a loan amount of $80,000. Okay, stay with me here for a second. So let's say it's $75,000. My rate is 5.5. Okay, 360 months, 5.5. Principal and interest on that mortgage is $425. Let me write that down. 84 cents. All right, let's take my $80,000 mortgage and say that interest rate is a whole quarter point higher. Maybe it's not quite that high, but let's just say 360, 5.75. Okay, 465. All right, so I'm going to subtract 465 at the 80%, 5.75 from my 425. We've got a $40 a month differential. Okay, so now what I'm going to do is I'm going to take my $5,000 of cash. I'm going to divide that by 40 bucks. That's 125 months, you guys. Your money is much better spent. And then the other thing is that think about, you've got to look at the dollars in real return space, right? What are you losing? I know that you're picking up 40 bucks a month on the monthly savings, but what would you be gaining if you deployed that $5,000 in an investment otherwise? Remember, too, that the interest rate can be your friend. Maybe not initially with the tax benefit, but once you've amassed, I would say, legitimately 5 or 6 properties, you should be claiming the real estate professional exemption, where that higher interest rate will almost certainly make up for that 40 bucks because you're claiming the interest as a deduction on your Schedule E. Again, I know that gets a little bit complicated, but hands down, go 80% and take the higher rate.
Right.
That's my opinion.
Yep. Okay,
Ben,
perfect.
do you?
Yep. Yeah, I would agree. I mean, every time I've done the math, it just makes more sense. Assuming that, you're not right on the bubble in terms of cash flow. If it meant the difference between making $20 or losing $20, then it would be a tougher decision. But we're not going to be anywhere close to that anyway. So I would agree. Go with the 20% loan and use the $5,000. Just don't use the $5,000 to go buy a boat or a
yeah.
asset.
Right.
The assumption is you're going to use that 5,000 to do something smart with it. Okay, let's see. Okay, this is a question from Lenora. Can you discuss the use of your IRA account value to create qualifying income for mortgages? So she's not asking about non-recourse loans or anything like that, but just how can you use the value of an IRA to help you qualify for a conventional loan?
So cool. So if your ordinary income isn't enough to get your DTI where it needs to be to qualify, let's take a self-directed IRA. There's different assets that this applies to, but usually the self-directed IRA is the easiest. So the rule in underwriting to use that income, it's got to be a regular distribution. You're going to have to set it up, and you're actually going to have to take it. Okay. Now, if you decided after you closed on the mortgage that you didn't want to take that distribution anymore, that's not something that's not my business. But here's the rule. So let's say that you need an extra $1,000 a month, right, to qualify. If you have 36 months of that amount in the balance of the IRA, I can use it. That's $1,000 a month of income. Let me say that again. So, or let's start over. If you need $5,000 a month of distribution income from the IRA, okay, as long as the IRA balance is $180,000 when we close, which is 36 times 5,000, then that is applicable. Those monies can be used to qualify you.
But you have to be able to take that distribution, right? So if you're 32 years old, you couldn't without taking a 10% penalty.
I think it depends on, yes, if that were the case. Everybody's going to be a little bit different, but yeah, the way they have it set up generally, or maybe I don't know, maybe they want to pay the penalty. I guess it depends on the circumstance really, but yes.
The bottom line is, yes, you can use it as income that will help you qualify for a loan that you otherwise wouldn't be able to qualify for. However, you actually have to take that distribution. You can't just say, hey, I could if I wanted to. Yeah. You actually have to take it.
And as a lender, because we are so investor friendly, that's something that we'll look for in our rigorous pre-qual process, right? So, if we come up short, I mean, we're looking under every rock. We're not going to be B of A that just comes back with a denial. No, we can't fit your round peg into the square hole. We will look for every option and provide the client with the options. Yeah.
Right. Okay. Well, here's a question that I think I'm just going to go ahead and give you some breathing room and try to answer, and then you just weigh in. What happens when the market starts tanking and all the properties value drop in this country? How much equity do you have to have in your property value so the bank won't take it from you? Well, the answer is you have to keep paying your mortgage. The bank's not going to take the property away if the loan is performing and if you're paying it. So regardless of the underlying value, if you've committed to pay a 30-year AM loan, God forbid, property values drop 20% and your $100,000 property that you got an $80,000 loan on is now only worth 60 or 70. I mean, that's a bummer, but as long as you keep paying the mortgage, no one's going to take anything from you.
Accurate.
Okay.
And if that plays into some of the 08-09 scenario, you guys, wildly, I mean, I can't even think of the circumstances that would dictate that we find ourselves in a place like that again. Will real estate continue to appreciate and depreciate? Market independent, right? We're never going to see a repeat, not in our lifetime, of what happened in 08-09. But yeah, real estate will appreciate and depreciate over time. Nothing that crazy. But if you do find yourself upside down, you are absolutely right, Ben. The lender cannot take your property based on its value, versus your outstanding principal balance if you are current on your mortgage. If you default, that's another conversation.
That's another story, right? Value doesn't matter. It's whether you're continuing to pay or not. And that's why, with Real Wealth Network, we don't recommend, nor do we have any markets where you don't cash flow. I mean, if a market appreciates wildly and it gets to the point where it's very, very, very hard to find a property that cash flows, then that market goes away. I mean, we don't have it on our website. We'll still support the people that bought there. We still have friendly relationships with the affiliate there, but we're not going to say, hey, yeah, go buy in the San Francisco Bay Area and pay, 1.2 million for a property that rents for $4,000 a month. No, that does not cash flow. It would not make sense.
That's 500 square feet.
Right, exactly. A lean-to built in 1976 with
right.
wainscoting and avocado dishwashers. But the point is, if you have $200 or $300 of positive cash flow, or even 150 between your costs and what you're renting it for, even if the property value does drop, and even if there is another 2008, you still got that cushion. Maybe when you renew, and maybe the rent will be a little bit less, but you'll still have a cushion. So anyway, okay, we've got like 5 questions on this, so I'm just going to kind of combine them into one. LLCs. What about loans under an LLC structure? How do you address that?
Okay, so this is a great question, and it's a little bit. How much time do we have? And we can go over 1 o'clock. Those people that can't say okay. All right. Yep. I don't know that we'll get to the other ones because it's a little bit lengthy. I can take time too talking about this next Saturday, but LLC for conventional financing is the only time it's a problem. Specialty, commercial, short-term fix and flip. Nobody has an issue with LLC except for Fannie and Freddie. So all of you listening probably have heard about a due on sale clause. Sometimes it's called a demand on sale clause. This language is present in every set of conventional loan documents the individual will ever sign. It states, you do not intend, I always say intent is the operative word there, I'll come back to that. You do not intend to change title ownership, and that if you do, the lender can exercise this due on sale. Now let me quickly define that. That's a scary way, you guys, of saying that you would be forced to refinance that mortgage at your expense. They are not going to show up at your house with handcuffs. They are not going to levy your bank accounts, okay? But, I mean, we can all agree that the cost of a refinance is more than enough incentive that we want to avoid it at all costs. So I get it. Now let me quickly give my disclaimer, cover my backside, and then I can kind of put into perspective and share from my experience. I'm not an attorney. I'm not giving anyone on this call any legal advice. Continue to do your due diligence, and then proceed as is appropriate for you and your family and your goals. Over 20 years, I have executed an instrument that is called a quit claim deed. That's QUIT. Sometimes it'll be referred to as a warranty deed. But I've executed this instrument hundreds of times, whereby transferring the title ownership from my name into my LLC without any issue with a due on sale. Likewise, for as long as I've been doing this and working with investors, I can tell you probably tens of thousands of times I've known of my investor clients doing it. It has never come to my attention that the due on sale clause came up or was an issue. Okay, you are still signing a legal document that says you don't intend to do it. There's my final disclaimer. All right. Now, I have a series of commentary beyond that, and I have this conversation probably half a dozen times a week at least. If we have time, Ben, and you think it's useful, I can kind of package all that up and put it into perspective to maybe ease some of the concerns about LLC, or if you prefer, I can talk about it next Saturday. What do you think is best? It's a little detailed.
I think that let's do this. Let's talk about it now. People who are interested, I got like half a dozen questions on it. We'll stick around. It's okay if we go over 10 minutes or so. But let me ask this one other non-LLC related question, and then I'll go over our typical end of webinar stuff, and then we'll go back to it. That way, if people have to go in an hour, we packaged it neatly for them. So the other question here is about HELOCs. And the question is, if somebody has a single family home, paid in full, no loan on it, owned free and clear, and they want the second property, What, in your opinion, would be the best way to finance the second property? Two options. Option one, go ahead and get a HELOC, home equity line of credit, on property number one to get the down payment for number two, or go out and get a portfolio loan for number two. I think the assumption is this person has their 10 golden tickets, so they would have to finance the new property with a portfolio loan, or they can get a HELOC. Any opinion on HELOCs?
I love the idea of a HELOC, especially if you can find it on an investment property. They're not easy to come by. We don't do them. We don't do lines of credit. But I'm going to play devil's advocate. I really like the flexibility that the HELOC provides us.
Yeah.
You can use it. You can pay it back. You can use it again. It's a nice safety net if you ever needed to have access to that. So it's a nice flexible tool. Cash flow should still be good because it's interest only, usually at prime plus or minus some reasonable percent. So I like the idea of a HELOC. Now, you'll have a hard time finding this. Like I said, there's two companies that I have heard of. I've not vetted for myself, so I don't want angry calls. Penn Fed, PENN Fed, I believe, has HELOCs on rental properties. Mm-hmm. And Bank of the West, I also believe, offers. Is that okay to say, Ben?
Sure, why not?
Okay, yeah. Bank of the West. So check there and see, what the criteria is to qualify, rates, terms, et cetera. If you can do it, do it. Otherwise, maybe a full cash out refinance might not be a horrible idea, because here's the other part of the devil's advocate. It's variable, right? The HELOC's going to change, and we know rates are going to go up, and it is interest only. You're not paying any of the principal unless you pay extra. So those are some of the downsides if I'm trying to, help you look at both ends of the candle. I think it's circumstantial, and for whoever has that question, feel free to call me and we can look at it a few different ways together and actually put some numbers on paper, so it's not just this audio kind of.
Okay. Perfect. All right, and one other HELOC question, and then we'll close out, but then we'll stick around for 5 or 10 minutes and talk about LLCs.
Okay.
If one does have a HELOC, but they're not using any of the balance, so they've got a $100,000 home equity line of credit, but they're not using any of it, does that affect or count against you or your DTI, or does it not?
The DTI, no. If there's no balance, no payment, it's not going to count. However, it will count as one of the 10 golden tickets, because even though it's not leveraged, there's still a lien against it's recorded against the property, so it'll count as one of the 10. Yeah, but not against the DTI.
I never knew that. So a HELOC does count as one of your golden things. Wow.
If it's a first lien, but let me clarify. So if you have a property that's got a first mortgage, right, a fixed mortgage, and then a second HELOC, that's one count, not two.
Oh, okay.
Right, just to clarify.
Only if it's in first lien position. Okay.
Right, if it's the only,
Got it. If you got a rental property that's worth $500,000 and you've got a first loan that's $100,000 and you've got a HELOC number two for another $100,000, it's not counting as two golden tickets. It's only one.
Correct.
Gotcha.
So, all right, so this is from a lending perspective. A couple of things first, you guys, that we need to agree to before the second half of the commentary is applicable. First of all, for any lending institution, okay, B of A, Chase, Wells Fargo, whoever we're talking about to execute this due on sale, we would have to agree for this conversation that such an entity would have to go and get everybody that they are the note holder for that put their property in an LLC. Okay, think about what would happen if B of A went after Ben Eric Smith only and left everybody else alone because Ben put his property in an LLC. Think about the class action lawsuit, right? If they were to target him or single him out. So if we agree that statement is true, then we also have to agree that we'll just keep using B of A, that B of A has the manpower and the resources to do such a thing. Now, I know B of A is a huge conglomerate with very, very deep pockets, but I promise you they do not have the manpower and the resources to do what I just described, to get everybody that they hold the note for that put properties in an LLC. They don't. But for our conversation, both of those statements equal true. Here's the following commentary is what that would look like. So B of A would do at least a 24-month chain of title search. So what that means is they're going to look back in time, in history, at least 24 months. and they're going to have to search every county in every city in every state of the United States. They're going to pull a master data tape of every residential properties that is held in an LLC today. They're going to take that list and cross-reference it with their own data tape, right? The property addresses that match for the notes that they hold. And then they have all this information. What is it that we're saying they're going to do? They're going to call all of those performing notes due and payable. So you guys, what they can do and what they will do, I think many people that kind of understand this part of LLC tend to be two very, very, very different things. For me personally, the risk of this due on sale did not outweigh the benefit that the LLC provided me in asset protection. Now, very important, the LLC itself must be a single member LLC. Okay, the only exception to that rule would be a 50-50 with a spouse, because it's your spouse. If you were to change the title ownership and put it into a multiple member LLC, where the other members were not on the loan with you, what you've done in this case is you've changed the asset's ownership, and that could actually be an issue. Okay, so single member LLC, 50-50 with a spouse, and let me just add one more comment about this. Let's say I'm wrong. Let's say everything that I have just said is totally incorrect, and it happens all the time, and banks are always executing due on sale for LLC reasons, okay? It is my understanding that a bankruptcy judge is the type of judge that would hear such a case. And I have an image, and I find it very difficult to believe that in a courtroom you got, I'm just going to keep using B of A, it's probably not fair, Chase. You got Chase over here and their legal team of experts, and you've got Ben Smith over here with his lawyer, and the judge is deciding whether or not to rule in Wells's favor by saying that you violated your documents by transferring your title ownership from your individual name into your single member LLC, which is you. It's a pass-through. You're the only one obligated, et cetera. I just find it very difficult to believe that that would be the scenario and the outcome of such a reality. So,
right.
Do your due diligence. That's my personal experience, my advice. There you have it.
There you have it. Okay. Well, that makes perfect sense. I mean, a lot of times you just have to do a reality check, and I like that image of the bank on one hand and the bankruptcy lawyer and me with my little lawyer on the other side, and kind of a David and Goliath situation.
Right.
All right. Oh, and somebody wrote in, says Wells Fargo and Fremont Bank also offer HELOCs on investment property.
Oh, cool.
So now we have PenFed, Bank of the West, Wells Fargo, and Fremont Bank. Obviously you have to call and check, but that's good to know. All right. Oh, geez. Yeah, a lot of times people bring up the LLC subject with me when I do strategy sessions, and it's such a difficult conversation to have in a short period of time. You really have to, and you talk to 5 different people, you'll get 5 different answers.
Absolutely.
So it's really, okay. All righty. Well, let me see if I have any other questions that are appropriate, since we still have over 100 people tuned in listening here. I think that about does it. Let's see if there's any. Let me just ask this question. If I have 10 Fannie Freddie loans, I pay cash for the 11th property, then I cash out and refinance after 6 months and 1 day. What kind of loan can I get for the 11th property? I think that would be your non-conventionals, right?
Yeah. So real quickly, non-conventional, well, the 6 months does not apply on a cash-out refinance unless you use leverage to acquire it. There's some other rules. Talk to me independently. But specialty only requires, that's conventional, okay? Specialty on a cash-out refi only is 90 days seasoning before I can use the ARV to 75 or even 80%. Maybe I missed the question, but that free and clear property, they want to do a cash-out refinance of, and they're going to put a specialty loan on the 11 and use the proceeds for number 12?
Well, she didn't mention anything about number 12. She's just saying that, like, okay, I can't get a golden ticket because I've got 10 golden tickets already. They're already used up. So I'm going to
Okay.
pay cash and then wait 6 months and a day and then finance at that point. But I mean, I think
Well,
there would be no point in doing that. Might as well just finance non-conventionally up front, right?
might as well. Yeah, why not? Why not?
Yeah.
I mean, I think it depends on if you're going to get a higher ARV by any substantial margin than what the purchase price was going to be. Then there may be some extra leverage there. But otherwise, yeah, I would say if it's equal purchase price versus ARV, just purchase it with the specialty loan to start with.
Right. So here's another related question to the LLC thing. Once you move the property into the LLC, it is a problem with your insurance company because you now are not properly insured. And then she has a follow-up. Once you ask the insurance company to change the policy to the LLC so that you are properly insured, then they notify the bank. Again,
well, so they're notifying the servicer, you guys, what's happening there. And I understand what you're saying, and I get it. A scenario I've done equal amount of times is I've had to change the title ownership. You are correct that the insurance itself needs to then be changed to the LLC name. The notification of that is going to a call center of sorts. It's a servicing department of the lender. You know, everything else I said, I still think applies. But at the end of the day, if it helps you sleep better at night to have them in the LLC, great. If it makes you more nervous and it's causing you to have sleepless nights because of that due on sale and the risk of refi, which, by the way, they would give you ample time. If I am wrong, you know, refinance a few $1,000, which, again, great incentive to avoid it. But it's not like they're going to say, get it refinanced in a week, you know.
right.
Anyway,
Yeah.
Yeah.
They don't want to call the loan. I mean, that's the bottom line is, like you said earlier, what they can do and what they will do are not often the same thing. They're very different things. So even though they have the power to do it because of the due on sale clause, are they going to? Does the bank who holds or the entity that holds your note, do they really want to call the loan? No, they'd rather make their 5.25% over the next 30 years on it. So they're not really, I think maybe the risk would be, maybe the risk would be like, let's just say, and I've had this brought up before. Let's say it's 1979 again, and interest rates suddenly go, or not suddenly, but they creep up, and they're at 15%. Then the banks actually kind of do have an incentive to get out of all those 5.25% loans they made in 2018.
Okay, that's fair. That's a fair statement. But then my argument back at that would be they couldn't pick and choose. Right? They're going to have to do it to every single person that's done it. And I have a real hard time believing that that's going to go over.
Right.
That the big boy bank is going to be the little guy for an extra 10% of interest because they put it into a single member LLC.
Right. And they're going to have to go with everybody. Otherwise, they're being inconsistent, and lawyers would have a field day with that.
Profiling and
Yep. Okay. Okay, here's the question I was going to get back to, but it's also an LLC thing. So we just be retreading old ground. So there you go. Never mind. All right. I think that does it then. Every single question we have is kind of asking the same thing in a slightly different way. So if you are interested in working with Caeli Ridge of Ridge Lending Group, you can see her number on the screen, 855-74-RIDGE, RIDGE. Email info@ridgelendinggroup.com. Website, same thing, www.ridgelendinggroup.com. Or, lo and behold, you're on our website as well, just realwealthnetwork.com/pro. Basically, you log into the website. Right up at the top, it says resources. You click resources, and then under lenders, there's Ridge. And you just click on it, and there's all Caeli's information. And then if you could just advance. You're welcome. Thank you. Advance one more time, and we'll talk real quick. Upcoming, you are going to be at the Saturday, September 22nd event we are having, not this Saturday, following Saturday, the 22nd in San Mateo. The event goes from 12 to 3:30. I think you are after Chicago, so around 1-ish. And then Sunday, you're not going to be in on Sunday or Monday, but at Sunday and Monday, as well as Saturday, we have our 3 affiliates, Chicago, Kansas City, and St. Louis. So if you're interested in that, please come by, register online ahead of time. I won't belabor it. We talked about it at the beginning. And our general MO here at Real Wealth Network is that if you want more information on any of these affiliates, you want to get specific information on how to reach out to City X, Market Y, or whatever, just have a strategy session with your investment counselor, and you can get all that information online as well. So Caeli, thank you so much. And for anybody still listening, of which there are quite a few of you, there's all the information right there. I won't repeat it, but thank you so much, Caeli. I'll see you in a week and 2 days in San Mateo.
I'll see you then, Ben. And thank you all for allowing me to take up your lunch hour. This was great. I had a wonderful time. I hope to meet some of you in person next week.
Absolutely. I'm sure you will. Thanks so much, everybody. And for those of you who don't know, we do this every single week, 12 noon Pacific, 3 p.m. Eastern. We do a webinar just like this. It will be archived and will be on our site tomorrow. You just go up at the top where it says resources, webinars, recent webinars, and there it will be. Just give it about a day. It takes a little while for it to filter through the process. But this is Ben Smith signing off. Thank you very much. We'll do it again next week. Bye-bye, everybody.